It's a bit of a delay here, isn't it? Good grief. Well, welcome, folks. I was delayed in arrival, but I got here before the economic news driver comes out here in about 8.5 minutes or so. So I'm not promising a very long one today, and usually when I do that, it's usually like a inside joke. We're not going to be here long, or it's going to be a short one, and I've got a 4-hour marathon going. Today, it probably will be around an hour or so, maybe a little bit over an hour. So discussion today over live data. Before I get into it, I kind of like want to give you an idea where I think we're probably going to try to reach for. And you probably see my mug down here in the right hand side, and it was covering up some price action, so I got to try to make sure I don't hide the pertinent details. So I'm going to put the 5-minute chart over here, and I'll adjust it as we go along. In the middle, I think what I'll do is I'll leave the middle as a 30-second chart, and over here we'll use this as a 1-minute chart. Now it's a little wonky. It's not usually how I have things laid out, but because I have the live stream set up in the YouTube channel to put my watermark with my mug over there, my face, my mug shot here. Today we have employment data coming out at 8:30, so that'll probably be a worthy news driver to send us reaching for a different pool of liquidity. And I like the idea of it wanting to explore the February 21st. Now I'm going by memory, so give me a second and I'll show you the daily chart where it's anchored and why I'm talking about it. But because we're going up against this live news driver, I want to kind of like do some of the tape reading here first. And before I depart, I'll give you some key points about my ICT order block. As a warning, since the day of the eclipse, that evening I ended up getting sick, and my wife is still fighting it too. So the video might go pause, like not pause, but go mute periodically. That's me coughing up a lung. So we want to see market draw down, or let me rephrase that. We're already starting off on the wrong foot. I am interested in seeing it draw down to this level down here for the NASDAQ, okay? And let me show you the reasons why I think that is something that is noteworthy. That's this low right here on the daily chart, and it's February 21st, 2024's low. Now, it need not go down there, but I suspect, as we talked about on the 8th of April when I did the last live stream, I mentioned how we would likely go into our seasonal tendency, and we would start to see lower prices. And I don't know if your charts show it, but it's been lower prices. Now, it was interesting. I found that it was rather interesting, the return all the way back up to take out the initial high impact news driver for last week, which was here. So they took it all the way back up above this high here. And that's what I teach you always. Go through the core content, go through the mentorship, go through all the lessons. Anytime I'm talking about a stop run, if they're going to run stops and you have a directional bias and it should be applied to your weekly or daily chart, that is going to be the strongest directional bias for you to focus on. Don't get caught up in a 1 minute chart, the sub 1 minute chart, anything less than an hourly chart for bias. Don't do that. If you pick your bias based on the weekly and the daily and live there for your bias, you're going to get far fewer losing trades. Now, let me rephrase that so that way no one takes that out of context, because you're hearing, I'm never going to lose. He finally gave me the golden ticket. No, it just means that that's where the largest degree of probability is going to reside in terms of picking the right direction, because you have a weekly chart suggesting where the market may draw to, which is how I teach. Then you have the daily chart moving in concert with that same direction. And it's going to have its own individual objectives as well. It may not reach that full weekly objective that you aim for, and it may not reach for that full daily objective you're reaching for. That means if you're bearish, it might be reaching for a singular swing low where sell stops would be residing just beneath, or relative equal lows, like a double bottom where retail likes to see that and they want to be bullish because of that very thing. I've hopefully changed that paradigm in your mindset where we see that as opportunity to run out the street money. So we attack those types of things. And because it's prevalent, it's always in the marketplace. They're never going to hide it from you. They can't hide it from you, okay? And it's on every time frame. And based on what your weekly and or daily bias is, then that will determine whether you're going to be buying or selling, and not getting caught up in the minutia of intraday price action, seeing big spikes in one direction and many times against what you think it's going to be, or against your daily or weekly bias, and you think, maybe I'm wrong. Maybe this stuff doesn't work, and I need to go in and start chasing price. And then when you do, you get your hinder part slapped, and then you regret it. You lose money. Then you are afraid to take the trade that forms in your favor, in your bias, in your setup. But now, because you've bruised yourself, you second guess yourself, as you should, but you went against your bias. You didn't stick to your model. You didn't stick to your plan. You didn't stick to the underlying direction of the marketplace that's being derived from your analysis on the weekly and daily chart. So I teach, and I have taught ad nauseum, when there's a stop hunt, they're going to run the stops before the big moves. Back when I was on baby pips, back in 2009, 2010, those periods of time when I was just introducing some of the things that many of the concepts I ended up teaching, I didn't really want to share publicly, but I got caught up in the fever of people liking what I was teaching and using it, making money with it. Not that I'm encouraging to trade with real money, but I taught that if they're going to run the stops, there's only one reason alone that causes the market makers to take the market up to a period of any time frame to take that level of stops, if you're bearish, that's above old highs or above an old high. So if they're going to run buy side liquidity, they're doing that for the express purpose of knocking individuals out of their seat that would be profitable if they held that short, and taking their seat over, and tricking traders that would have a limit order, or I'm sorry, not a limit order, but a buy stop that would put them in a breakout long entry. Either side, I don't care. I don't need to know the ratio of what traders are trying to do. I don't care. I just know that the charts are always going to be able to show you this, and it can't hide. It won't ever change. That is not the algorithm, okay? So it's never going to be reprogrammed. It's not going to be coded differently. They're not going to turn things upside down. It's simply because that's the lifeblood of the market. It's liquidity. So if we can arrive at a bearish bias, and I gave it to you on the eclipse day in our live stream, we're looking for what? Seasonal tendencies to take price down into the spring decline. Now, if they come above this high here on the daily chart, look over here on the left-hand side, this chart here, because I don't have a way of highlighting my cursor. There's our employment data. So we ran real quick to take this low out here. Let me put some lipstick on this as I talk. Sorry, I was supposed to mute that because I'm going to be doing it probably a lot. And I apologize if it gets in there in the audio. But this high here on Wednesday, April 10th, when they ran that high, there's only one reason for that, because they were going to be running for the sell side below these lows in here. All these lows here and that low rate there. And I told you I was looking for less than 18,000. If you're a student, you know that. It's in public record now and you can't change it. So the idea of looking for long protractions in price, okay, where you're not looking for this little tiny little choppy moves that take place in intraday charts. Like for instance, we're looking at the 30-second chart here, okay? All of this right here, all this back and forth type movement, that immediately gets individuals that are on the sidelines waiting to take a move or trying to be in a trade because they know that these news drivers that come out around 8:30 tend to create a lot of excitement in the speculators that sit in here and try to gamble. So to remove the opportunity, and go over here and look at this 5-minute chart real quick. Okay, see that fair value gap? We overshot a little bit. I like the idea that it went up in there, and I want to see now, does it want to start to move lower? I think this was potentially the initial run here. If we're going to go lower, let's just say it that way. If we're going to go lower, it's already done enough for me. But if it doesn't go and start breaking lower, these highs here are a little too suspect for me. So they left a little bit of a trap on both sides of the equation here. It can go both directions, and then later at 9:30, and I'll still be here at 9:30 with you at the opening bell. But I want to see what they do with this information that they just released to the public at 8:30. And so far, it's kind of lackluster. Okay, it's done enough to go up into a premium relative to the high and the low prior to 8:30, and then went up into this fair value gap. Because if you look through all this, and this is a 5-minute chart, that's not to say there isn't other smaller time frame fair value gaps, but for the 5-minute chart, whenever you're using days that you're trading high impact news drivers like today, always at least refer to the 5-minute chart and try not to place so much emphasis on anything less than that. Any other time of the day, it's completely acceptable for you to use a lower time frame than 5 minutes. But 5 minutes kind of smooths out a lot of the spottiness that can, by characteristic, on a high impact news driver day, because there's a lot of individuals that are looking for the things I've taught, but you have to understand the characteristic of the session or the day that you're trading. And you can hurt yourself trying to force your trade entries on a 1-minute chart or a second chart on a high impact news driver day, because you demand or expect to see something, be a catalyst for your trade being profitable or unprofitable. And the way you offset that and mitigate the underlying risk with doing that very thing is just focus on high impact news drivers at the time of the news release at 8:30 for at least 15 minutes, 15, 20 minutes. Okay, if you really want to be safe, wait 30 minutes. And then you can start dropping down below 5-minute charts for looking for inefficiencies, because you're probably not going to pick the right one on a lower time frame chart that's less than 5 minutes on a high impact news driver day, because the market can traverse both sides like we see here on the 30-second chart. See that? So if you're looking at a 30-second chart, that's a nice little fair value gap, and it's also a balanced price range. But listen, it's below what? A 5-minute chart. This time frame is 30 seconds. So every individual candlestick represented in this chart in the middle measures the highest high and the lowest low of every 30-second interval. So on a high impact news driver day, at the time of the release of the data, you do not want to be using a 30-second chart, because it's going to disrespect all the spottiness and inefficiencies on that time frame. Why? Because the very nature of the high impact news driver, it's going to reprice to a larger degree of movement higher or lower, seeking stops and limit orders to drag into the marketplace or knock out and unseat those individuals. That's what the algorithm does. It's not focusing on these small little inefficiencies here like this. It can, and you can look back in history and say, well, here's where ICT said it didn't do it, but it does the. I'm giving you a general rule to eliminate the majority of the confusion you're going to have if you try to look at less than 5 minutes. If you try to look at less than 5 minutes during the news impact driver, that spottiness in price that is easy to work with when you're not using a high impact news driver day or the session that just had that release of data like we have here. In short, basically, at 8:30 on high impact news drivers, medium impact news drivers, it's kind of like hit or miss. So if you want to have a general rule, use the same thing there. But if it's going to be a day without a medium or high impact news driver, just because there's an absence of data being released at 8:30, the algorithm still does these types of things anyway at 8:30. The news driver just adds rocket fuel. Okay, it kind of like boosts the level of volatility because it's going to reach for higher premium arrays or it's going to reach for lower discount arrays because of the very nature of it. And it's told to you that it's because there's no liquidity. No, there's lots of liquidity, but brokers pull the ability for you to transact because their risk goes off the charts. That's what they're doing. Okay, that's why you can't get the best fills right before non-farm payroll or as non-farm payroll is happening. It's not because nobody wants to buy or sell. Believe me, everybody's greedy. They all want to be in there doing it on that very moment. But the brokers pull access to that. Now, one can argue and say, well, we're arguing semantics now because that just argues the very point that's being made by everyone else saying there's no liquidity. There's lots of liquidity, but there's not letting you plug into it because that brokerage, every broker, has elevated risk because there's a lot of mavericks out there that will simply overhand bet and just put too much risk behind every little trade they're putting on. Just look at what you do with your funded account challenges and why they're blowing. What you're doing there, everybody else is doing that with their live account. And that's why you get the statistics that hardly nobody makes any money trading because everybody wants to be the gambler. So anyway, you can tell I've been away from y'all too long. I want to go down different rabbit trails. But long story short, 5 minute charts, that's your time frame, the lowest time frame you got to look for in terms of inefficiencies, okay? Only on high impact news driver days at the time of the release. 15 minutes minimum up to 30 minutes. Then you can drop back down below 5 minutes because then the spottiness, and what do I mean by that spottiness? Like this right here. That's a volume imbalance. Okay, that can stay open. It doesn't even need to trade back down there. Why? Why could I say that and feel that that's a true statement? Well, one, it can still trade down there. But because of the high impact news driver day, these tend to stay open. And if you're very limited in terms of your experience and you're trying to walk out here like it's going to be easy for you just because you watched, a binge watching session of 18 videos of mine over the weekend or whatnot, and you got all these things buzzing around your head, you think the answers are on these less than 1 minute charts, and they're not. There are new challenges there, and it requires you to have more experience. Now, on a day where it's not associated with this high impact news driver that just released a few minutes ago, it's only been 9 minutes. These tend to come back and fill in and reprice to. And if you're bullish or bearish, they are influential in terms of my analysis. It may be a foothold for another partial entry for a long or short. It may be the entry of a new position. It may be a target for me to take a partial in an existing trade. It may be like a line in the sand, a divider that says, I'm no longer interested in holding on to this trade because it went to this PD array. Remember, I teach 3 PD arrays. If you have a trade on, you have to have not only an ideal stop loss that's measurable in terms of a risk that you can assume and not be overextended or over leveraged, but it has to have a way where you can have 3 PD arrays above it if you're bullish or below it when you're bearish. And I think I may have said that wrong. Let me say that again. When you're bullish, your stop loss has to have 3 PD arrays above it. And what that means is they're like barriers. Okay. You'll have a discount array right above your stop loss, and another PD array that's a discount above that PD array, and another one above it. So that's what I taught many times in a Twitter space. I don't have a lesson where you can go on my YouTube channel. I taught these things audibly. This is all part of psychology, trade psychology, why you're able to hold on to a trade, what constitutes a reason to bail on the trade, when do I take some of the trade off but still hold it and see if it wants to pan out. That's what those Twitter spaces were. In my opinion, if you took all that stuff and you incorporated that into your trading, that's the best trade psychology stuff you're ever going to get. I have lots of books on trade psychology. For the most part, they're all dog shit. Most of the time, it's written by people that don't even make money, can't even tell you what the market's going to do beforehand, and how they're going to tell you how to manage a trade when they can't even be consistently in a position where they can manage a winning trade anyway. So they can give you a really good depiction of what it's like to deal with losing. They can give you an idea of what it's like to always most likely fail with their retail stuff. But a consistent diet of winning, I found that most of the writings about it is pretty much useless. Okay. With all due respect to Mark Douglas, he's like the closest thing that you can get to it, but he's still lacking a whole lot of stuff. So I'm no disrespect to him, but there's a lot of things that he could have delved into and would have spent his space in lettering in a better economical way to talk about other things than the things that he talked about there. Not to diminish what he mentioned in his book, because it's good, but it didn't reach far enough. And I guess, anyone with 30 years experience, studying these markets, they're all going to have their own opinion about trade psychology and their own war stories and what they learned. And I'm trying to convey what I've learned over the last 32 years. And it's a lot to try to compress real quick. And remember that fair value gap right in here? I told you I'm interested in that one. It overshoots it a little bit in here. Okay, you see that? Let me actually draw it in so you can get a visual of what I'm talking about. And that's not going to do it. ICT, you got to do better than that. There you go. So anyway, on high impact news driver days also, you have to allow for a little bit more outside the lines, or coloring outside the lines. Okay, it's acceptable, it's permissible, but now because we have already traded to this fair value gap here, let me widen it up a little bit too. There you go, you should be able to see it nice now. Looking back here, there's no inefficiency until we get right there on this candle. Okay, the candle I'm hovering over with my cursor here, that's the only inefficiency on that time frame, that one. Okay, this being the 5-minute chart on the right. Because if you keep going up, there's really nothing in here to speak of in terms of inefficiencies. Now, you do have all of these consecutive up-close candles, which makes that a what? An ICT bearish order block. It's not a engulfing candle that's, all these guys out here from these multi-level marketing scam sessions and societies and communities out there, they've tried very hard to rebrand my stuff. And it's all wrong, okay? But these up close candles, if you take the body or the opening price of that lowest one and draw that out, okay? Draw that out to the right. We'll do that here. Sorry, I was supposed to mute that. I'm not going to remember how, that I'm used to talking and then going back and going through all my edit points and then taking all that kind of stuff out. Coughs, my dog's barking, my wife saying, hey, how much longer are you going to be? All that stuff usually in every one of the videos that you watch, but because they're pre-recorded, it's all edited out. So I don't have the luxury of having to do that when I'm live streaming. So you're just going to have to suck it up, buttercup. So this is the wrong color. And yeah, it's just as big as we're going to make that in terms of width. But because I believe, and I may be wrong, okay, I can be wrong here. So it's really important that we're casually discussing price. We're casually talking about my concepts. So that way you're not under the expectation to perform today. If you want to trade, turn off this live stream. It'll be on our YouTube channel and you can watch it afterwards. I won't be able to edit it. It'll be just like you were watching it live, okay? But if you want to trade, go do that now. Don't let me influence it. But looking at this, we talked about the very paragraph I got right there. And it's a premium array. What makes it a premium array? Well, the fact that we return back up into it here, what was the range prior to that? What was the dealing range? This high. I'll have to frame it out with these levels here. We'll make it black. Okay, so that's the high end of the dealing range, and the low of the dealing range prior to that return to that fair value gap right there is that low right here. Okay, you see that? So that's your dealing range. So what the algorithm does, it takes that range. How does it determine that range, ICT? If it's really an algorithm, how do you determine what a dealing range is? Well, first of all, you have to determine what your directional bias is, because if you don't have a directional bias, you don't have a dealing range. Okay, you're just using randomness. Okay, you're determining, oh, here's an old high, here's an old low, and we'll just call it a trading range like every book out there does. That's not what I'm doing here. I see this old low over here on the daily chart, right here on the left-hand side over here, the far left chart, that right there, the February 21st low. That's my personal interest. I'm accepting the fact that I can be wrong, because this week has already demolished and went way beyond my objectives for the week. In fact, everything I was looking for this week, it happened just on Monday alone. So it was a very overzealous Monday. And that's characteristic of what? When you have high impact news. If you're not taking notes and writing this stuff down, folks, you're really missing this, because you're not going to remember it otherwise. But we had CPI and PPI, and those are huge market drivers. And if they're occurring later in the week, Wednesday, midweek, if you're expecting a big move, if it doesn't happen by Wednesday, then you anticipate the latter part of the week to be big candles. But because we had CPI and PPI, those are introducing many times what? Large range candles, lots of volatility, big movement. So on the weekend, everybody's looking at their charts. They're looking at old videos of other people expecting certain things to unfold in the marketplace, or they're part of signal services and people paying for mentorships, and their opinions are being shared. So they're chomping at the bit to put their heroes analysis to work. And as soon as Monday happens and starts trading, everybody dogpiles in the marketplace. Why? Because they don't want to be in those big price swings that can hurt you, PPI, CPI, that type of thing, like a FOMC type thing. If there's going to be an FOMC event, in the week, that means usually the beginning of the week will probably be really nice. And then you can get your nice setups there. And then the uncertainty and the volatility and the carnage that comes because of the highest news impact drivers for the week, everything is usually wiped clean. It'll usually knock someone out of the marketplace, and anyone that's been profitable usually gets unseated. So anyway, the dealing range high here, what makes this a dealing range high? Well, we're moving from this low all the way up here into this inefficient. I'm going to have to drag this down a little bit, sorry. All these inefficiencies here, this one, we're trading up into that, okay? This candle's high. If you're looking right here, right underneath the word says NASDAQ, right there, you're looking at that value. The high is 17,724 even. And what does that say? 17,724 and a half. That's all it takes, folks. It has to clear a high to do what? To engage opposing liquidity. When you have that, if you're bearish, you want to see does it displace lower. Displacement is movement one-sided and heavy, in this case because we're bearish. If it was moving higher, it would be steady and consistently moving higher. Well, we're bearish. I've been bearish. My students know I've been bearish. I told you on the eclipse today that we're going into a seasonal tendency to move lower. This bump above that high, once it starts making lower lows, we're aiming for this to be swept. It does. Now, to get in sync post 8:30 news release. We go back through that range. That high is the highest high of the dealing range. That low is the low of the dealing range. Why? Because we've taken the buy side here and we've taken sell side. So it has engaged what? Both sides of the market, short term. What time frame? The 5-minute. Why 5-minute ICT? I told you earlier in the video. In this live stream, if you're looking at high impact news driver days, at the time of the release, minimum 15 minutes, you can't be underneath a 5-minute chart. Otherwise, you're going to get beat up with the spottiness and price action. 30 minutes for good measure. Okay, so for anyone that's, I'll just say this, every one of you as a student of me should just use wait 30 minutes. I personally like to use 15 minutes, and I create all this stuff. So if I'm telling you I'm willing to wait 15 minutes after the news release, so in this case it would be 8:45, then I can start looking at a less than 5-minute chart. So I can look at a 4-minute chart, I can look at a 3-minute chart, 2-minute, 1 minute, and less than 1 minute. Okay, so there has to be rules, folks. If you don't have boundaries and you don't have barriers to prevent you from forcing something to give you information that it's not likely to be good data, it's not influential enough for me to trust it on a 30-second chart because of the very nature of the high impact news driver. It's designed to run wider than you're probably going to expect it to seek liquidity. Okay, and it can many times go beyond where you think it might just reach for a premium array if you're bearish or a discount array and be bullish, and then go right to where your stop loss would be because you're trying to anchor it to a 30-second chart because you're thinking I can do 15 contracts in my funded account because I'm using a 30-second chart and my stops are small. Well, you're asking the market to bend to your will in a level of precision that's going to evade you more times than not because of the very underlying characteristics of the time, the session, and because of the high impact news driver day. And if you want to arm wrestle that, you're welcome to do that. Welcome. Go ahead and do it. And lose your ass like I did a lot of times as a 20-year-old. And then come back and regret and say, you know what, ICT, I'm typing in this email and you said I was going to do this and feel like this and I am. And I should have listened to you. Right. Because I have scores of that every single week. People coming back to me saying, I breezed through your content. Thank you so much for it. And Mike, by the way, thank you for the gift card. Please don't take this as an invitation to send me stuff. But I threw away the envelope. Usually I mail back a thank you or whatever. And I didn't see an email address or an online name or something. I could just reach out to you that way in the comment section on the YouTube channel. But you know who you are. I've had their crab cakes. I don't think they're the best. I think Ruth Chris down on Water Street has the best crab cake, but I'm biased. But it was good. Thank you so much. My wife enjoyed it. But so I know when you get into a live session with me, I'm all over the place. Like, can't you stay on point? I'm on point. You got to catch up and keep up. But when we have both sides of the marketplace swept, we have it here, there, and that low's taken. So what has the market done? First, what has it done? It has bumped the buy side. Does it displace? Yes. Is it able to take out the low? Yes. So what is this? This is many things here. This sets the tone for, and this is exactly how I taught my mentorship, the people that paid, and you can see the core content lessons where I say it. You're going to discover how all my concepts overlap. And the strongest setups are going to be the ones that you can see have multiple reasons why it should do one thing and not the other. Meaning, this low being taken out, remember the bias is bearish. I don't need it to trade down to this daily low. I just need it to be able to move in that direction. Now think, if my bias is bearish, do I sell short on a break below that old low down here? No, I'm not retail Rick. I want to see the market come right back up into the range. Why? What is that doing? Well, let's see. That's model 2022 on this YouTube channel. That's what this setup is here. It's the OG, longest running flagship pattern of the YouTube channel. And this is what I taught on Baby Pips, my optimal trade entry. high, low, retrace. You don't believe me? Let's pull up a fib. Here's 50%. Is the fair value gap above the 50% or at it? Well, here it is. That means it's a premium array. So it fits the criteria for model 2022. It also, if we go into the settings, and some of you want to screenshot this because this is my fib settings. I get so many emails. If you just watch the videos, you're going to see this. The things that change down here are usually these types of things, okay? Because I'll change it to 20 and 30 because if I'm managing or measuring the range on the weekly chart for TGIF setups, and you can watch a video on my YouTube channel, just do search on TGIF. Thank God it's Friday. That's what it stands for. It's just simply measuring 20 to 30% of the weekly range, and it's an opposing or counter trend, counter momentum, if you want to call it that, setup where if I see my objective for the week traded to, sometimes in the afternoon, like 1 o'clock in the afternoon on Thursday, going into Friday, can start this retracement back into the weekly range as much as 20 to 30%. And usually, that's about as far as it'll do. It can do a whole lot more, but usually that's a pretty systematic way of approaching how to trade the conclusion of a weekly range objective, and then any of that little tiny little retracement lower, or not. I shouldn't say lower because it can be bought or sold. It's not directionally specific, but I teach all that stuff in TGIF, so you don't need to hear it here again. But these are the settings I usually work with. Sometimes if I'm measuring a range that's large, some of these numbers will change. So don't think that these are cast in stone. But this is the standard deviations I use to measure. And when I'm looking at these over here, this is what I also do. I change, because this is measuring the 62, which is the low threshold on optimal trade entry. And then you have the 70.5. And I just did that wrong. I got to pull that back up. Sorry. Okay, so here's the 62% retracement level. And here's the 70.5. Why 70.5? Because that's the sweet spot. You can use the 79% retracement level, but like I taught on baby pips, if you're demanding that or just below it as your entry, you're going to miss a whole lot of sweet trades. So you want to know what that 79% retracement level is, because then you want to look just above that. Let me show you what I mean by this, because otherwise I'm going to confuse you. Okay, that's the 79% retracement level. So this is the optimal trade entry area here. 70.5, that's my high watermark for shorts. Like if I can squeeze something in at that price level, I'm going to try to do it. But 62% retracement level is about as good as I need it to be. And I'm going to have most of my limit orders if I'm trying to sell short in a short that is optimal trade entry and my bias is there and it's a lot of things going for it. I could enter right at 60% retracement level, and then I'll layer additional limit orders. They may not fill. If the market starts to move in my favor, I'll just close the existing limit orders. But I'm not trying to do a 79% retracement level entry. I'm not trying to do an 80% retracement. I'm not a harmonic trader because I think it's utter bullshit. The markets don't care about your rabid bat pattern. None of that stuff is none of that. It's all cartoons. That's a religion. You need not waste any time or money on that stuff. It's garbage. But ranges and understanding the range and the liquidity and why the market should reach to a specific level or a direction, that's where 99% of your focus should be. Always. Even when you know how to trade and you know your model really well, all of your focus and time and analysis should be spent on that weekly, daily chart. Why should it behave a certain way on those two time frames? Keep referring back to it. Is it still showing you things that would warrant you trusting your initial analysis? Is it really trying to still reach for that objective as you outlined on the weekly chart? Is it really trying to reach for that objective as you outlined on your daily chart? And as long as those two things remain true, you should never fear holding on to the trade. Because otherwise, how do you know if you have no experience or limited experience, how do you know that you're going to be right about that, let alone be right about the initial trade idea? And I could go on and on and on for hours and give you a book rendition audibly about how nobody writes that stuff because they don't know it. But you have to be diligent about journaling and recording how you feel and how many times you wrestled with looking at your analysis on these lower time frames and forgetting, completely omitting the reasons why you went into the trade. If you're going to ignore, once you get in a trade and then you're going to be all whipped up into a frenzy with these lower time frames, you're going to ignore the core reasons why you took the trade. And if you don't know why you took the trade, and if it's not rooted on sound logic, any little thing you see on a 30-second chart is going to change your mind. It's going to scare you. Someone's opinion about something. If you see me taking a trade, or if I talk about something, it's going to completely undermine your own analysis. And that shouldn't happen. I've had many times where I've had students trading the very same market I'm in. And I'm looking for a particular setup because I'm looking for a larger run. I'm looking for a bigger move. I'm not in here trying to fancy dance around and trying to catch, a couple handles here and a couple handles there. Not to disparage anyone that's doing that initially, because it helps build your confidence. But you don't want to be discouraged by me or anyone else if your analysis has been framed on the weekly and daily chart and you trust what it is you're looking for. Nobody should have any influence on that. If I can influence your analysis, and sometimes I go into my students' live streams, if I'm audibly saying something, well, I shouldn't say audibly, if I'm typing something out, what I'm doing is I'm testing their resolve. Like, I want to see, can they stick with their analysis, or are they going to look at me as a hero and wipe the analysis away and say, well, he's talking to me in code and he's trying to tell me to do it. No, I'm not. I'm testing your resolve. Because if you really are my student, you don't care what I'm saying about that market, because you've already done your own analysis, your own homework, and you're going to co-sign with nobody. It's just you. It's a one-man show, one-woman show. You're out there as a one-man army against everybody else that's trading that same market. And I'm not going to throw you a cookie. Perfect example, Tanja trades. I've done it to her twice. And I physically saw, I visually saw her physically change because she read my comment. And she was doing something opposed to what I mentioned. And it completely undone her and unsettled her. And thank you for the flowers, by the way, Tanja. Very nice of us. We appreciated that. But I test my students' resolve because I want you, if you're a student of mine, you don't care what anybody else thinks. And you have to be real comfortable being the minority. You're comfortable being that person saying, all of you are all wrong. Until the market takes the money from my hands, you are all wrong. And that's what a consistently profitable mindset has to be. Because if you're out here letting every tide, every little change in the breeze on social media, on Financial Times, newspapers, articles, whatever, commentary that you hear on TV, listening to live streamers talk about, things that they don't know nothing about. If that has any influence over you, you're not ready to be trading with real money. And that's the clearest indication that you're not ready. So I don't know how I got on this subject, but let me climb off my soapbox for a moment. The fair value gap is above the 50%, so that means what? That's a premium array. I pointed to it, and then the trade can be taken where shorting here or trading into the 62, the 79% tracing level inside that area, and I've already told you the 70.5 level, that's that sweet spot, okay? I dubbed it the little sweet spot for optimal trade entries for ICT. So I'm trying to get that price if I'm using optimal trade entry, or just below it. And I'm layering limit orders in if I'm going short at the 62% tracing level to the 70.5. I am not trying to get the 70.5 level, because many times if you go back and look at your old data, you'll see that it just touches 70.5. And will that fill you? No, because you need the spread. And there's been many times over my career where I've tried to be laser precise about entries, and I've missed phenomenal entries and watched them run without me. And when I was younger and I was figuring all this stuff out, I was demoralized because I didn't know how to get in a move that already started. I was afraid. Well, now my stop's going to be even bigger, and I was doing the right things, and it was teaching me the lessons of not being greedy about where I wanted to place my entries. And it helped me manage all that stuff. Yeah, you can have a smaller stop loss if you get right at that level, but what's the practicality behind that? You're insisting that you're right, and I'm not always right. You're not always going to be right. So the dealing range this is how you define it now. Listen, this is for your notes. A dealing range is a high that has engaged buy side and a low that has engaged sell side. So now you've expanded outside the realm of the nearby close proximity liquidity. Well, ICT, you're trying to tell me, listen, you've got that mentality, get the fuck out of here, okay? I'm telling you what works. I'm telling you what you should be doing, okay? And these are things that would be in chapters in books, okay? So this is what I would have paid an arm and a leg for if someone would have sat down and told these things to me. A dealing range is not a dealing range unless it takes both sides of liquidity, period. End of story. And it must be on the time frame you're looking for in terms of the analysis. So hello, have you noticed that we're talking about that 5-minute chart? You see it? So the high and the low, these two here, that's defining the dealing range. If anybody's teaching anything other than that, that's not a dealing range. That's their interpretation of a trading range. And there's nothing wrong with that, but don't call it what I'm teaching. Don't run with my words and say, well, this is what that is. Okay, because that's kind of like what I'm here for today. I have an axe to grind. Let's put it that way. So the dealing range high and the dealing range low, we have to then see what? Where's the market going? What's it reaching for? You have to have something in terms of a longer term bias. Well, there's nothing better than a daily chart. Well, a weekly chart is better, right? Weekly than daily. But in terms of day trading, the daily chart, most of everything you're looking for, like I don't need a weekly chart. I just like teaching with a weekly chart because it gives you a very, very long range where you can see a lot of targets that would otherwise evade you. And I learned this the hard way by holding on to trades as a younger man and just getting my little objectives and thinking I was winning. This is it. This is the best thing in the world. Yeah, this is great. And then it would just keep on going and keep on going and keep on going. Not to say that it still doesn't happen, because many times the market can just go way beyond what I'm looking for. But I'm not kicking my dogs around the house because I didn't get all that move. I might say to myself, wow, I got to leave that part out when I'm parading around in front of my wife, doing my Mick Jagger moves, like, ha ha, there it is, peacocking around. I'll leave that part out because she don't need to know everything. Okay, there's nothing wrong with keeping something back. Okay, it's not sin. A lot of you guys out there nodding your head, yeah, go, preach, brother, preach. But when we're looking at dealing ranges, okay, they're useless to you without having a directional bias, and you derive that from the weekly and the daily chart. And what do you mean by the ICT? Well, the same thing I just showed you here with the daily chart. Okay, back here. It would be reasonable. Okay, it would be reasonable if these lows in here were broken, and you go back to what I was teaching you on April 8th in that live stream. I said we're going to be entering a seasonal tendency for the markets to go lower on a protracted manner where it's not just a one-day event. It's going to draw down in direction. And I'm not predicting a crash, and go back and listen to it. I did not predict a crash. It's just I was indicating to you that I'm looking for the best moves to be going lower. That's all I was indicating there. Okay, so try not to make too much out of it either way. But if those lows are going to be taken, wouldn't it be reasonable to assume that the sell side that's outside the scope of these lows here on the far left chart, if it's going to keep going lower, where's the inefficiencies? Well, you got it here. You see that? This range here, what is this? Here's a little bit of a quiz for you. It's a buy side imbalance, sell side inefficiency. That is not a liquidity void. There's a whole lot of liquidity being exchanged back and forth on here. It's a daily chart. It's not void of liquidity. It's inefficient in the sense that it's not offering much in terms of sell side, listen, sell side delivery. That means the market needs to offer prices going lower. And we get that with this candlestick over here, where it goes down. This inefficiency, because I don't teach supply and demand, because much like harmonics, that's bullshit too. If you look at the BISI, buy side imbalance, sell side inefficiency, and you frame those two levels here, you're going to find the real support resistance. Now, I'm not a support resistance trader, but this is what the algorithm refers back to. The market's trading lower, like I told you on 8th of April, 2024 in the live stream. It starts moving lower, it attacks the sell side, and it goes down and trades beyond this buy side imbalance, sell side inefficiency. So what's the algorithm going to refer back to? This level, the lower quadrant, consequent encroachment, which is the midpoint, upper quadrant, and then the high. The market trades here yesterday, or what was that? Yeah, Tuesday. Trades up into it, bumps it. One more time yesterday, boom. Displacement lower. See that? That's not random. That stuff repeats all the time. Now, how many of you are looking for these types of things to frame setups, barriers of trade profitability or targeting, where you're demanding the price move beyond the scope of just what you see on these lower time frames? Like, unless you have these levels on your chart, you're not going to fully appreciate what it's doing and how it moves. It does this all the time, all the time. When you see this, you'll start to, you'll flesh out the initial mechanics behind my inversion fair value gap. Because when price is bullish and it trades down into these areas like it does here and runs, yeah, you can trade it with those mechanics behind your trade. But what happens when it breaks it and you are in a seasonal tendency when you're bearish and you're on a higher time frame chart? Well, you want to have these levels on your chart, because then you'll see setups that would otherwise never be noticed at all. And I watch live streamers. I watch other people talk about what they think the market's going to do. And okay, let me slow down here, because I know some of you are brand new, or you just the first time you're listening to me, and it sounds like all you're doing is talking down about other traders. No, I'm telling you how to use other people's opinions appropriately, the correct way. If your idea is bullish or bearish, and you're using the concepts I'm teaching you the very concepts that the street money is going to fall victim to, because many times they're trading against this approach. They're trading against this intellect, this mindset, this perspective on price action, because they're looking at some kind of indicator or a list of indicators. And they believe, like a religion, that that's going to cause price to go up or down. And it has absolutely no bearing on price. Zero. My order block, my inefficiencies, and when we're talking about buy side imbalance, sell side inefficiency, or SIBI, sell side imbalance, buy side inefficiency, either one of those, they're not an assured outcome. That's not promised to you, because it all hinges on, are you looking at the market at the right time? Are you looking at all the characteristics that are associated with that very session of the day that you're trading? And what have they already done in price? You have to factor all those things in. And if you're brand new or relatively new, and anything less than 2 years, in my opinion, is relatively new, you have very little experience. Okay, you got your feet wet. And you can make a lot of money in your first 2 years and not really understand what you did, but it feels like you're smart. I've been there. So you learn these types of lessons by applying what you're looking for on higher time frame charts, and those levels carry over to your smaller time frames, and they won't be hidden from you. You won't be so inclined to say, well, you know what, I see this market's rallying up in here. You know, it might take this high out here. I'm bullish. It's going to go up in here and trade into this sell side imbalance, buy side efficiency. Why should it do that? Because it's already shown a willingness to go up there, reject, and then we opened here, we trade back up. I'm looking for the midpoint and a failure and not get above that high. Why? Because it's already overshot this buy side imbalance, sell side inefficiency. So inside of this little area, all close proximity on lower time frames around the 17,954 or thereabouts, you can look for premium fair value gaps to get short, or up close candles to be treated as my bearish ICT order block. You do not look at a down close candle above a high that's been broken and wait for it to trade back down into it and think that that's going to support the price and go higher. Don't do that, especially when the market's underlyingly bearish. It's not going to happen. It's not going to happen at all. You're going to get burned, and you're going to walk away thinking, wow, I watched this guy try to take 32 years and compress it into a 5-minute trainer. Learn ICT in 5 minutes. Learn how to do everything ICT taught incorrectly in 5 minutes and learn how to regret watching that 5-minute trainer. That's really what it is. Okay. You want something that's going to teach you how to talk like we do. You want to talk the talk because it makes it sound believable when you're in your live streams or if you're talking in your videos in hindsight and doing market replay stuff. It's altogether something different when you're out here when the market's moving live. So you have to really learn how to do it. Otherwise, don't bother. So when you identify these levels on a weekly and or daily time frame, it allows you to see the marketplace through the lens that is against the grain, because everybody else is going to be doing something that is in every retail theory, and none of the stuff that you see me teaching you, like today, who's looking at that level right there and calling that a level of support or resistance? I'm going to tell you right now, nobody's doing that. Nobody. They're looking at this level right here. They're looking at these levels here because they're close together. They look like what? Double bottoms. Well, that's a support level, but it was broken. So what are they going to expect? The market's going to trade up to that level because that's a double bottom, broken, now turn resistance. That's bullshit. That's bullshit. I can't tell you how many times I've blown an account believing that nonsense and hoping it was going to finally start working for me. Nope. Nope, 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 nope. So you have to look at how the market creates these inefficiencies, because the algorithm will go back to those levels and offer one more instance because it's already done the work of going up here. And what's it lacking on this candle? Between the ranges of 18,192 and 17,954, it's only offered on this time frame what? What did it offer? Buy side delivery, not liquidity. Listen to what I'm saying. It's offering buy side delivery. That means momentum and delivered higher prices. So because it's only this single candle that's traversed from the previous candle's high to the second or the next candle's low, this range has only been traversed by that one individual candlestick or one day, specifically February 22nd. Because of that, anytime we get into it here, if we're bullish, that's an area where we can anticipate what? Down close candles on smaller time frames. That would be my ICT bullish order block. Or on a smaller time frames, short-term lows that are taken out, as long as it's the right time of day, they could be turtle soup long entries. Gears are starting to turn, aren't they? Or you can wait for a smaller time frame displacement in price where it takes out a short-term lower time frame high that leaves a fair value gap. When it trades back down to the fair value gap, you buy that because you're trading with this idea that it's gone down into this inefficiency. And as I taught in the mentorship lessons, if you measure this right here, watch, I'm going to pull a fib up. Now the fibs aren't magic, okay? This helps me measure a range to teach you with the language. I had to create a language to try to teach this stuff to you, because much like you see all these assholes out there, oh, he's rebranded it. Save everybody the time. Okay, save everybody the time. If you believe that, come collect $5 million because nobody's got that bounty from me yet. If this is all regurgitated somewhere else, okay, show us where it's at, do a list, the page numbers in the book and the author, okay, and be done with it. But because nobody can do that, that's how you know they're horseshit. But as I taught in the lessons, if you're bullish, okay, if you are bullish, inefficiencies that are, like in this case here, we're defining this one, the best place for the entries on longs are not, listen, they're not in the lower half. Why? If you've been a student of mine and you've been journaling, you heard me say this, not in one time, but ad nauseum. If it's bullish, it won't want to come back down here. That's what you really want. That's a signature and price delivery that you really want to have that. So it's better for you to look for the long between this candle's low, which is the high of that buy side imbalance, sell side inefficiency, which is a fair value gap by classification. But specifically, it's buy side imbalance, sell side inefficiency, meaning it's an up close candle. And the best buys will form consequent encroachment, which is the midpoint of that inefficiency, to its high. Look at the sensitivity and price right here. Look at that. That's near perfect. That's diabolical. And because they created what? Relative equal lows, what does that look like to a retail trader? Oh, that's a double bottom. We can put a stop loss and go long. Oh, okay, we got you there too. And then it takes the higher high out. When we have this, we cannot, listen, we cannot, absolutely not, you do not look at the down close candle here and think, okay, when it trades back down there, I'm going to go long. Because what you've done is insisted upon the market now has to bend to your will and make even a higher high here when it's already done so with that high being taken there. This has now been exhausted. It can trade down there and have a little bit of a reaction, but you're gambling doing that. You're absolutely gambling. That is not an order block, okay? That is not. The market trades down one more time, midpoint of that buy side imbalance, sell side inefficiency, multiple times here, and rallies. Does it take out the highs over here? No. Is it tradable on a lower time frame, like a 1 minute chart or 5 minute chart? Sure it is, absolutely. But my trades, I try to frame them on the context that I've outlined on the April 8th live stream. I want to see long distance protractions beyond the scope of just what it's going to do in the next couple minutes. You know, you get out there and you put a trade on, over leverage. Oh, got my 17 points. I got my 9 points. Let me get out of here. I'm done. And then watch it keep on going. 150, 250, 500 handles. I want to be in the mindset where my trades can, they don't have to, but they can move way beyond what I'm looking for an objective. Contrast that with how you're trading right now and what you're trying to set as a parameter for your trades. You're trying to box yourself in. You want these little tiny little, always easy short term. Okay, that's good in the beginning, but you have to grow outside that 5 handle run, and then stretch your boundaries and try to be more flexible and allow for 10 handles. Then do that for a little while, get comfortable with it when you're bored, and then go to 20 handles and do that for a little while, and reach for 30 and so forth until you get up to around 100 handles, and then use that as your bare minimum. The barrier to entry for you as a trader, your setups have to yield potentially 100 handles or more. And guess what that's going to do for you? It's going to filter out a lot of bullshit trades that you shouldn't be taking anyway. But see, you don't want to do that. You're thinking, I can make a whole lot more money having 1,000 contracts linked together over the span of dozens of accounts, and you can make your money like that. You can, but it tricks you into thinking you need to trade all the time. Whereas if you just go in there and you look for these big monster moves, the effort is so minimal. Your risk is reduced because you're only going in with the initial risk of whatever that trade was initially, and then you manage it as it runs. You can add more to it in pyramid, larger position size as it's going. You don't have to enter your whole position in the beginning. In fact, it's probably better you don't do that. But you don't listen to those good advice. You don't listen to that because you see other people out there showing you the one time, the few times, the winners, the things they did right, but they're not showing you. I shouldn't say that. There's individuals out there that show where they blew it. And I have a lot of respect for that. I actually encourage a lot of that because in this industry, you have a lot of people out there that are going to lie to you. They're going to say, this is what the gospel is in trading, blah, blah, blah. And there's no fruit behind that. No one's making any money doing it. They don't have any students doing it. So it's very suspect. And that's why I've been highly critical. My whole entire time on social media was highly critical of other people, demanding them to just bring forth the evidence that what you are saying is in the marketplace and what you're saying works, and is it replicable? Because if it's something I say I believe in and I go out there and I do, and I'm the only one that can do it, and it's what's the point? My whole point of coming out and trying to teach was to help other people do what I know they're capable of if they have the right information and they have a process. But it takes a lot of due diligence on your part as a student that you have to, number one, know some general rules, and you have to operate within them. And if you're not willing to do that, how can you measure your progress, and how can you say if it works or doesn't work? Because you're not doing the process correctly. You're not submitting to that process correctly, which is in effect a lesson in itself, because nobody likes to do what they're told. I mean, think about it. You have kids, you know what it's like. Believe me, I have adult kids, and I thought it'd be easier once they grow as an adult. And I'm bailing them out, and Dad, I did this, and I bought this, and this doesn't work like I thought it was going to work, and this car sucks. I should have picked the one you said. Right, you should have listened to Dad. Right, you should have listened. But I gave you what you wanted, and now I'm picking up the tab again. Anyway, when we have this retracement in here inside the dealing range, why? Because we're looking for lower prices. We're in a seasonal tendency where lower prices are welcome. They don't have to be. It's an election year, like I mentioned on the 8th of April's live stream. Everything can get thrown out the window. So it's important not to over leverage your trades right now. If you're in here trying to push as much as you can because you can afford to do so leverage wise and margin wise, you're doing it wrong. I promise you, you will regret it. You might have a good win here and there and get these real big windfall victories, but eventually, you're going to have to pay the price. And that price is going to be a lot more than you're willing to pay. And that knock against you, where that loss is going to hurt, it's going to make you mad, and you're going to want to get it back. And that starts the whole train wreck where you end up blowing your account because you're trying to be too emotional about it. So when we see the low that took out this low over here and this high here, that's our defined dealing range right there. That's what that is. It has to take both sides of the marketplace. Now here's the cool part. If you're bearish, you want to see. Now listen, this is something you have to really appreciate over time seeing it. Don't take my word for it here, but it's exactly what I taught in mentorship. Okay, the paid mentorship. You can watch those core lessons on my YouTube channel, the playlist for every individual month. How do I go in what order to watch all these videos? Well, it says month 1. Why are you trying to start in month 5? Because people are talking about month 5. Start month 1 and go through the process. And don't try to watch them all at one time because you're not going to retain it. But I taught, and I'm going to remind you here, this is not a Cliff Notes version, okay, because there's other details in that lectures that support and help you understand what benefits this brings. If you're bearish, you do want to see buy side taken first, then drop down here. You don't want to see market trade down, take out that low, and then take out buy side. That's a dealing range, but that would be against the grain of what you're looking for. And let me say it this way. It would be against the grain. See that small little volume imbalance right there between the body's closed and the body's open? That's what that candlestick. I'm watching that as I'm jawboning. You want to see, as I was talking about on the daily chart, if I'm bearish, as I indicated on the 8th of April in our live stream, I said we're going to be looking for lower prices. It bumped that previous high right there. And I'm sure some of you that were in that live stream or watched it afterwards, like, oh, ICT got it wrong. What a scammer. Well, long story short, you're wrong, because it went up there, took the buy side, and then did exactly what I was looking for on the longer term macro time frame. Longer term runs lower. That is the key to you finding consistency and deriving bias. That's the if I had to answer what question I get the most through TradingView Messenger, emails, posts in my comments, okay, or the comment section of my videos, is please teach bias. I've been teaching bias this entire live stream here. But see, you want 1, 2, 3 checklist, easy. It's always going to work, and I don't have to do any work. It's just a matter of it just automatically works. And I wish there was a way for me to teach it like that. But it requires a number of things that have to come in an agreement. So what do I mean by that? Did you hear Bailey snoring? Bailey's my oldest puppy, by the way. The daily chart, if we're looking for a draw on liquidity, that means the market's going, here we go, the opening range is starting. So now we've taken out that low right here. So now just know that that's 670.25. That was the dealing range low. And I'm just going to take this off and drag that to here, because the only thing we did was just expanded the range. And now we've done what? We created this high, this low. So now, because the opening bell has happened, this is our dealing range now. See that? Why? Because we have a change in session. The 8:30 news driver is now behind us, and the opening bell and the volatility that's associated with the opening bell, and inside the opening range, which is the 30 minutes between 9:30 and 10 o'clock in the morning. You see how you have to have all this stuff, folks? You thought it was just watch a video and I'm going to figure it all out. I'm going to go to this guy's seminar. It's going to reduce everything ICT teaches. Bullshit. That's bullshit. That's bullshit. Don't be tricked by that stuff, okay? There's no shortcuts. You're going to have to work your ass off. It's a lot of studying. It's a lot of effort. But now we have the expectation. When we're bearish, we want to see buy side taken, because as I mentioned over here and at the beginning of the recording or presentation, is the best moves are going to be associated with an initial run on stops. The initial run on stops. That means if we're bearish, we are anticipating, we're expecting, we want it, we are inviting it. We're looking and studying to see if the market wants to take out buy stops, because if we're bearish, that is the smart money showing its hand to you that they are going right up there to knock out these individuals that would otherwise be profitable. Because look what they did that day. Last Wednesday, they did what? They dropped it, but they left all the sell side there. You see that? So they bumped all the way up here to take those people that had shorts on. They're not allowed to be on the ride. They take them all the way back up to here, and they're going to puke their guts up and say, I can't hold this short. And then once it starts dropping again, they're scared. They don't want to get short. I'm afraid it's going to stop me out. So they don't get in. And then they drop it, and then they accelerate through where the sell side is. And then as I taught you here, right in here, that inefficiency, there's no need for it to trade back up to here. Why? Because first of all, it's retail. That's retail logic. That's double bottoms being broken now should act as resistance. Man, throw that shit out. Don't, if you trade like that, you're not going to find these types of setups. You're not going to see it visibly. You're not going to know what it's doing. Listen, folks, look at the chart. Is this hindsight? Is this hindsight? Did I not tell you that fair value gap right there? Keep your eye on that one. Look at this slide right here. If you close right now, I'm sure some of you took shorts. If you ain't taking profits right here, take partials right now. Take partials, move your stop to break even, and then you can relax and listen to the rest of the jawboning session. But you're not watching this in a pre-recorded edition, okay? I gotta bite my tongue because I really, really want to say something now. I have to keep my promise and say nothing. But this is the draw, the 21st of February. So if they're going to bump and run the stops here, and we were bearish, we've known about it since April 8th because some guy on the internet, the ICT, said we're going into a seasonal tendency and it's likely to go lower. And if it's going to go lower and we've already taken out sell side, well, this is a range here, right? That low to that high. So where's the sell side at? It's below that low right there. So for it to drop as much as it's done here and not take out the 21st of February's low, it's kind of like wasted. Like, why would they take it down this far and not go at least to take out that sell side? They can. It's happened before. I've been in trades where it's done that, which is why I teach. And as I mentioned just now, because I know some of you are short, and this is probably the biggest trade you ever had in your career. Well done, but you didn't earn it. So don't go on social media and parade around and say, look at this shit. I did this. Bam. Hello. Holla. You can't do that kind of stuff. You listen to me talk about it. That's not something you should congratulate yourself for. Okay, I'm not going to high five you. You shouldn't be taking the trades. Watching, observing, and listening. Because now what you've done is you've given yourself a sweet tooth. You want every trade to pan out like this one. You want every move to pan out just like this one. And when you get your own analysis, you scrape together your own reasons why the market should do something, and you get into it, it's going to hem and haw or go against you. And it's going to be more detrimental to your psyche as a trader than if you would have just watched today pan out without you putting anything behind it. In contrast, the people that have taken the trade and they're in here short up in here, well, yeah, they made money, but they know They didn't earn it. They didn't find that trade on their own. They didn't take that because they found it. They're listening to me in front of however many people are watching me. And I felt inclined to talk about it. And I gave you my bias. So you had all the boxes checked for you. But you have to do that when I'm not part of your trade. When I'm not captaining your ship, you have to have the confidence, the wherewithal to stay with it and trust that, well, these are what the concepts say I'm supposed to do. And I'm growing in my experience and my learning. So I have to press into that uncomfortable periods where I don't know if it's going to pan out. I don't know if it's going to work because you haven't been there enough times. Let me give it some room because we're going to blow through it. Yes, it's boring seeing this stuff all the time. But the your stop loss, should be rolled to 660. There you go. There's your live analysis. Put that in your fucking pipe and smoke it. Oh, he always gets it wrong. I get it wrong when I want to get it wrong. I'm still waiting for this fucking joker to end up on a leaderboard. Where are you at? Teeny mini motherfucker. Come on. April 6th, you were supposed to steamroll on in there. I told Joel Robbins to tell me when you get in there. I ain't heard shit from Joel. Where is he? Where is he at? Oh, shit. Where's Vinny at? You ain't here. I'm ready to chap your ass. Come on. But you ain't coming out here. Why? Because you're a fucking eunuch. Okay? You have no balls. So anyway, I had to get that out. I had to get it out. So we have covered the dealing ranges. If we're bearish, we want to see buy side taken, then sell side. Then we have a defined range. Then you measure that with your fib. Wherever the halfway point is, that halfway point is your equilibrium price point. Now, when that occurs, that you have a bias that's bearish, when you have a time when you're trying to execute, like 8:30, that's your news embargo lifting, where news drivers come in. Even when there is no medium or high impact news driver at 8:30, the market still will operate under algorithmic principles and it'll still spool. It'll create these little Judas swings. Okay. And a Judas swing is a fake run. It's a fake price run that is against the direction that you think the market's going to go. It's going to go a different direction than what is initially being shown. So if you're bearish, many times you'll see it spike up. Okay. Go back and listen to this live stream. Okay. I said, when it spiked up here, that's about enough. That's all I would require. What does that mean? Well, I already told you that I was bearish. And I told you that level right here on the daily chart is what I'm aiming for. So you have the highest time frames being utilized for determining the bias. Where should the market trade to? Why should it go there? And it's a time when the market can do what it can manipulate. It can manipulate the perspective. It can manipulate the expectations of traders. And how is that done? At 8:30, when that employment data comes out, we want to see, how many times have you had a bias and it starts running the other direction and you want to quickly abandon that and say, I'm probably wrong. It's just probably going to go up. Or if you're expecting it to go up and it starts dropping real quick, you think, I'm probably wrong. I better get short. Let me look for a fair value gap to sell short. You've probably done it a lot. And it's because you're not doing the things I'm teaching you here. Like if I did a paid workshop, no, I'm not doing this, okay? But if I did paid workshops, day one would be just like this. This is exactly what I did when I had individuals come to my home in the 90s and spend a week with me, okay? This is exactly what I would do. I would sit down with them and I'd say, okay, here's what's going on. And I always started with a high impact or a medium impact news driver day. And I would teach them just like this. So if you understood everything I've covered here, if you didn't take notes, you want to watch this all over again. Okay, I'm not leaving yet. I'm going to stay with you till 10 o'clock. But I've given you the very building blocks to determining what your bias should be, how it should be framed, and why you shouldn't be worrying about the lower time frame charts, because they're going to be not as helpful to you on high impact news drivers first 30 minutes. Me personally, I'll wait 15, but because you're learning this for the first time, you should subscribe to waiting for the first 30 minutes. So if it's a high impact news driver coming out at 8:30, you're not allowed to look at a 5-minute chart for your entry. I'm sorry, you're not allowed to look at anything less than a 5-minute chart for your entry. And some of you might want to argue and say, well, I get that. I can see how someone weaker, but I'm a better trader than most people. I'm a better student than ICT realizes, because if he only could see what I'm doing, he would know that I'm exempt from this rule. Okay, well, maybe you are. I don't know that. And really, you don't know that. I have some really amazing students that can trade very, very well. And they don't think highly of themselves when they could. So be careful. Don't let your ego push you into situations and circumstances where you're writing checks your ass can't cover. But the dealing range, I defined that today for you. Okay, so now you know what is a dealing range. What does it matter? Why does it matter? Because then you can frame whether the market's bullish or bearish inside that range when it retraces, which is exactly what you want. See, if you're bearish, we want to see it reach up. What's that candle right there on the right side candlestick chart here? My cursor, I'm going to show you now here. I'm in the far right chart. That candle is 8:30 on a 5-minute chart. I showed you the specific premium array. I did not need to put a Fibonacci on there. I did not need to draw that stuff out. Okay. My eye jumps to it because I've been doing it for 3 decades plus. You will not need to do this in time. How much time? Whenever it is for you that you get comfortable, that you don't have to have all the lipstick on your chart. But because I'm teaching, let me go back to what the initial dealing range was before the 9:30 opening bell. That was your range, okay? This is it. When we framed that with the fib, I showed you that was where equilibrium was, okay? So you want to see the market, in fact, trade at least to that. But what would that do for a trader? Well, it offers and invites the opportunity to trade a breaker, because that's what this is here. You have this drop down here and make a higher high. So there's a bearish breaker. There's one trade idea. Now look how they overlap. Then you have the fair value gap I pointed to. I said, look at this fair value gap. Again, go back and watch the live stream. I don't have the DVR settings turned off, so that way nobody can go back and look where I said something wrong. Go back and scrub back to it. You'll see me and hear me say it. This is the fair value gap I'm watching. And then you'll hear me say, this is enough for me. It's done enough for me. In context, what is that? It's created enough of a Judas swing, a counter move against the grain of what I was outlining for the day. The day is going to be bearish. It's going to take out the February 21st low of 2024. That's this over here on the daily chart. You see what I'm doing with all the charts here? If you don't have now listen, this is not a plug. I don't get anything from TradingView. Okay. They've offered me some kind of partnership. I've denied it. I've declined it. I've said, no, I'm not interested in it. I use TradingView because my community said to use it when MT4 was shown that you can game it. Okay. I didn't ever use a white label server. I didn't use a fake MT4 server. None of that shit was ever done by me. I couldn't do it to save my life if I had to do it. I don't know how to do it. Clearly, you can see here. What is it now? Is it a rented white label TradingView? Like I hacked the CME? Like your charts are showing the same damn thing mine is, and this is live. I showed you a 30-second chart, a 5-minute chart, and a 1-minute chart, well, and a daily chart over here. So you have all these different time frames. They're all showing it. Okay, every one of these charts have the market's open. It's not market replay. And I told you we were looking for lower prices on April 8th. Okay, so I gave you the macro perspective weeks ago. And now right there at the time of this discussion, we have a high impact news driver. How do we use the high impact news driver, ICT? Well, you got to be in front of the charts and you have to anticipate certain signatures. And a signature is things like this here, where this buy side imbalance, sell side efficiency, when it was broken in a time when I'm bearish, when it trades back up to it, that's your real resistance. It is not going back to this lows or this low. You don't want it to do that. The fact that if it went back up there, to me, would indicate it's not as bearish as I want it to be. Remember I was telling you about the buy side imbalance, sell side efficiency with this one candle here? You want the buys that you're trying to take at the equilibrium price point or midpoint of it, okay, which is what we call consequent encroachment when it's an inefficiency or a gap. A candlestick order block The midpoint of that is mean threshold. Okay, I'm going to segue right on into that in a second, but a signature is how it trades up to that level, and it should behave a certain way. It should behave a specific way that's in line, in concert with the understanding that you think that the market's going to move one direction or the other. If it's bearish, and I clearly told you on April 8th, that wasn't a daily bias. Go back and listen to it. I told you seasonally, we're going to be trading down in, in days and weeks, reaching into as much as May, the halfway point of May. So nothing's saying that this has created the low. And I'm not claiming to a time like a crash. That's not what I did there on the 8th. And that's not what I set up today. I was giving you all these puzzle pieces, okay, using my experience and showing you how to do this with live price action. Because there's a strong contrast to having things presented in a video, lecturing and supposedly condensing it. Just in this lecture today, I'm at the bare minimum of explaining it. You can't condense it any less than this because of the very subject matter in and of itself. You can't reduce it anything less than this. Yeah, you can take out the stuff where I'm talking about my dogs, all the others, the one-liners and cutting up with you, but you're still left with everything else I've said, and you can't reduce it beyond that. I took it down to the chrome. There's no bells and whistles. It's just, this is what it is. And you won't learn how to do this just by watching today's lecture. You probably were encouraged because you watch it pan out live. But it's not going to be easy for you. It takes time, and a lot of time, much more time probably than you're ready for. But answer this. If you could do this, are you going to listen to any Tom, Dick, and Harry on the internet say you wasted your time learning it once you learn how to do it? You're not going to give a fuck what anybody thinks. You don't care what anybody thinks. Because having this skill set, it beats inflation. You don't care who gets in the office in the White House. You don't care what their policies are because you'll be able to outpace all that bullshit. And if you have to, you can uproot and move somewhere else. Okay? You're not trapped where you're at. You're not trapped in wherever you're at right now in life. You're not stuck there. Nothing's holding you there except for experience and opportunity. And you got to get experience before you can recognize the opportunity. And when you have both of them, then you have life-changing events. You have things that completely uproot you in the levels of mundane mediocrity. And it elevates you to a level where you can produce and provide for your family better than you ever could imagine. Now, you're probably looking at this thinking, man, if I would have had 15 contracts on my funded, probably some of you did. You're wrong if you did that. You should have never done that. Don't take this win as a means to showcase and be like, yeah, I'm going to do this all the time. Don't do that. But this should have encouraged you because I gave you the tools. I've given you the reasons why over live data, talking to you. Therapeutic for me because I've been wanting to talk to y'all for a while now, but we had some things going on in our personal life and lost a mother, and it's a lot better than it was. My wife's doing better now. Thank you for the concerns. But I want to talk about order blocks, and then I'm going to close it. If you look at how I treat the market in terms of inefficiencies, and hang on, I got to check the sound because I don't know if I left the microphone on. I muted it earlier. Okay. That scared me. I was thinking to myself, man, if I talked this whole time, I've done that before. Right. If you've watched how I've taught you and showed you today with the inefficiencies like the fair value gap, I'm going to just maximize this chart here. Okay. And I want you to think about how I engage the marketplace with inefficiencies like fair value gaps, buy side imbalance, sell side inefficiencies, and volume imbalances. Okay, volume imbalances, they are like the weakest form of a fair value gap. But don't take that as, well, they're not worth it. I'm not going to bother with it because I've seen students in my comment section say, I don't even bother with volume imbalance. I don't even know why you bring them up. Okay, tell me you don't know what you're doing or what you're looking at without saying so. It's basically what you did there. So I'm going to maximize this chart here, and we're just going to look at the 5-minute chart. And I'm going to scroll down a little bit over here. And before all this drop, I want to zoom into this price action. So we're really just focused on that. That's our dealing range. That's what we were outlining live. And I'm going to take, just know that that 697.5 level, that's the midpoint between the dealing range high and the dealing range low. And we would anticipate a break below that low later on. But that has to happen after. Now, if you're not writing these steps down, you are wasting your time, because this is the recipe I use every single time. It does not morph into something else. It's not some kind of hidden thing that I'm hiding from you because I said this stuff in lectures. I've taught it to paid students. I have profitable students using the same process. And if you're not writing it down, you are wasting your time, and you will do it wrong and walk away thinking it doesn't work. Okay. You watched me say it today live. Is that scamming you? This is what I did for 6 years behind a paywall. And I asked my students every single day just to take notes and pay attention. And this shit panned out every single week. Not every day, every single week. I had a 90% strike rate plus. And I always said, if I'm not doing this accurately in front of you, you go out there and you expose me. And they never did it. Why? Because they saw what you watched today. They saw that. If you're not inspired to learn this, okay, if you have some kind of stick in your craw where your smart money concepts, it's this, that, thing, don't watch any of my stuff. Go do something else, okay? Because I'm not going to sugarcoat anything. I'm not going to sugarcoat it. I'm going to tell you exactly the way it is. I don't care about your feelings. This is the way it needs to be taught. This is the way it should be learned. And this is the process. If you do anything outside of this, you are not learning it correctly. I promise you, you will be frustrated. You will not see the results. Okay? This is exactly how I teach my children. I tell them this is what it's going to do. This is why you're doing it. This is why you're picking this high. This is why you're picking that low. Think about it. Was I ambiguous about anything today? None. Not one thing. Not one thing was I ambiguous about. Now, that fair value gap is above the equilibrium price point, which is the midpoint between a range high and a range low. A gap is like this little shaded area here, okay? A gap or inefficiency is always going to be measuring the middle point, and we'll call that consequent encroachment. Now, why did I name it consequent encroachment? Well, it's consequential to what you're expecting in price action for it to reach up into the midpoint of that inefficiency. And where's it encroaching to? The midpoint. Many times you'll see it trade and reprice to the midpoint of a gap or inefficiency and fail to go any higher. That's ideal. Remember when I was telling you about the daily chart with that buy side imbalance, sell side inefficiency? If you're trying to trade that as a bullish PD array, where it would be a discount array where you're trying to buy it, the best buys are going to happen from the midpoint to the high of it. You don't want to see it trade down in the lower part. Why? I know some of you are thinking, I wish you would say why it's better to do that. You think I was going to leave that out? Because if it stays open, that is a breakaway gap. You want every time when you're trading an inefficiency, you want to see that other half of the extreme of the range that creates that inefficiency or that fair value gap. You want to see it stay open. Think about all my examples when I'm showing you. I say, ideally, it should stay open here. I want to see this part of that stay open. Oh, that was an epiphany, wasn't it? That's like rocket fuel. Well, you should have taught like this from the first time, ICT. Well, guess what? I had a lot of jokers in my mentorship. I had a lot of assholes on the internet rebranding my shit, acting like it's theirs. But they can't do it live. They can't tell you what's going to happen before it happens. They can't be that precise with it. And that's why I taught the way I did. I gave just enough where I can string it together when I need it to. But students that did the work, exactly what I promised, they got the results they were looking for. So I was always trying to balance out, the assholes out there abusing what I'm teaching and taking it and running with it and pretending it's theirs. And the students that should be forced to do it on their own anyway. Because once you earn it and you work for it, using what I'm teaching here today, I can't call it back from you. No one can tell you it doesn't work when you have it in your hands working. When it removes all the uncertainty and it gives you clarity about what it is you're doing. I mean, think about this. Think about what it's like when you sit down with a chart and there's nothing on it for the first time. It's like a foreign language. Like, what the hell am I looking at? How does this guy know what it's doing? Right. That's how it was for me when I first started. But today, I walked you through the process. I told you specifically how to define a range that makes it a dealing range. If you're bearish and your bias is bearish, you want to see buy side taken. Even if it's by one tick, it's done its work. Then you want to see sell side taken. Once that happens, now you have a defined range. That is a dealing range. Why is it a dealing range? What makes it a dealing range? Because they're going to deal with the midpoint of that range. That's this level right here. So the algorithm will reprice at 8:30 right here. It's going to go up into that equilibrium price point here and seek a premium array. That's not a gap. That's a gap. So it trades into it, overshoots it. Are you going to get scared when it shoots up like that? Oh, it's going to keep going higher? No. Did you hear any kind of nervousness in my voice today? I'm in front of however many of you are here watching. I got to look at it and see. Well, 9,500 of you that I can see here. I don't know if that's the highest, but that's a pretty good audience. You all can hear. Do I sound like I was nervous? No. Absolutely not. When you are trying to learn how to do this, you're going to see that candle open up and trade bold-faced bullish like that. And you're going to think, oh, I'm wrong. And you need to change that mindset. Because if you're bearish, you want to time Judas swings formation. 8:30, the news drivers are coming out right here. The market opens on that candle, trades down initially, sweeps that low. Okay, that's wonderful. Now we have done what? What did we do? What did we do? We engaged sell side. So now we have our range. It's defined now. So we can drop our fib here up to that high. We're bearish, so we want to see a Judas swing. We wait. We're not freaking out. We're not running around. Let me get on social media and see what this guy's doing right now. Let me get on here and see what the #1 day trader is doing right now on YouTube. Let me see what this one's doing. Let me see what that one's doing. I can tell you right now, they're not doing what the fuck you saw today. They're not doing that. They're not doing that, okay? You watch the market rally up because that's exactly what's going to suck the retail traders in. Because there's a lot of folks who are going to see that low here and they're going to want to buy it. Because why? They think that that's support. And they're going to do what? Get burned. You're not trying to trade a breakout. That's not what you're doing. You want to see a Judas swing, which is opposed to the direction you think the market's going to go. That's that February 21st low. Hundreds of handles away. Not 10, not 5, not 20. Hundreds of handles away. Remember, you want to grow and graduate to the point where your barrier to entry for your trades, the trade has to yield potentially 100 handles if you're trading index futures. By having that mindset and that this is the minimum, I can only take a trade that affords me that much of a move, you're going to trade a whole lot less. That means you're going to pay a whole lot in commissions. That means that you're going to relax a whole lot more between setups. Now, it won't feel like that in the beginning. You're going to feel like I'm missing everything. Man, I could have took this 25. ICT is full of shit, man. I could have made 50 handles here. I could have done this. I could have done that. Yeah, you could have. But you need to slow your roll, cowboy. You got to learn how to control yourself. You have to learn. I just taught my private mentorship a very specific element to managing expectations and controlling your impulses. Like you don't want to be going in here and trying to throw everything at the chart and whatever sticks, that's when you're going to take to social media and say, look how smart I am. Because if you're trying to do that initially, thinking that's what's going to encourage you, no. What that's doing is it's tricking you into thinking that every situation must be like that. And then when you are trading the next setup in your charts, when nobody can look over your shoulder, that's going to haunt you because you're like, man, I can't live up to that last time I showed them. I can't live up to that. I can't live up to that. And then you're going to spend more time worrying about that nonsense than going through the process of what I'm showing you here today. So there's a whole lot of managing expectations, what you're going to do with this skill set while you're growing and understanding it, and then what your model is going to be. I kind of briefly started to go into seeing how many setups there was, where we have this high, low, higher high, not by much. It was only a half a point, 2 ticks. But that is a breaker. It's a bearish breaker. That might be your setup. For some of you, you're like, I don't see breakers or I can't trust them. Okay, fine, no problem. The fair value gap, is it above the equilibrium price point? Yes. That's the one I pointed to in the live stream. The market protracted higher. That's our Judas swing. I told you, okay, it's done enough for me. Go back. That means it ain't taking that high out. So what is it going to do? We want to see it trade lower. It does. But then what happens? It trades lower, takes that low out. So now we have a break in market structure. So inside of all this price action that would frustrate you, why is this marking time like that? What is it doing? My personal private mentorship students, they know what this is here. I talked about it a little bit. I glanced over it when I was doing Twitter Spaces. And no, I'm not active on Twitter. So I'm not doing Twitter Spaces. I'm not going to ever do another Twitter Space. But this is better than Twitter Spaces anyway, because you're visually seeing me do it and pointing to things before it happens and explaining why it should be this way. In Twitter Spaces, it's just me going on. And that was me just basically talking because I needed to talk. Here, I'm doing 2 things. I'm talking because I want to talk and I want to teach, and I'm also showing you stuff before it happens. But in here, I want you to look at the bodies of the candles in here. You see that? These are this whole section of price action. If we look at that here, and that's your lowest body in here, all this consolidation right in there. See that? That's on a 5-minute chart. If we take that and we go into a 1-minute chart, when you go to a physician, a doctor, and you go into him or her, and you say, I have an ailment, okay? Something's bothering me. Something is hurting me. I have some swelling. I have, a discoloration. Something's not right that's warranted you to go see this professional. And they're going to look at you, and they're going to tell you stick your tongue out, and they're going to check your pulse and your blood pressure and look in your eyes and check your reflexes, okay? That's them doing a weekly checkup or weekly chart checkup on you, the macro, okay? And if they can't determine anything from that, then they're going to do the next thing, which is go below the weekly chart and the daily. And the daily is going to be asking you to describe what you're feeling inside. That's like the daily chart, giving you an internal perspective of what that weekly chart is over the course of 5 days. Now, if they can't ascertain what the root cause of your ailment is from that, then they're going to ask you to piss into a cup or take blood from you, and they're going to check your fluids. They're going to check your chemical. They want to see what you have inside going on, okay? That's intraday. So right now, that's what we're doing here. The physician is looking at the lower time frames to get a feel for what it's telling them. As a technician, as a trader, when we're looking at price action, we're doing the same thing. So we want to look at these little areas here where there's a problem. What's going on? It's not moving, but it should. Remember? It should be moving lower. But why isn't it moving lower? It's waiting for something. What's it waiting for? 9:30 opening bell. So all of this right here is time distortion. That means you have to submit to where you entered, where your initial stop loss would be. I'm going to go back to that in a second. Let me finish this part and then we'll go back up to the 5-minute chart. But all of this in here, because of the waiting element that needs to be worked through, okay, we had 8:30 news driver here. We went up to the premium array, swept it one more time. They bumped the high here. So now the market should go where? Lower. But it goes lower just to take out the low, and then it's chopping back and forth. This is where, watch live streamers, okay, and look at your notes when you're in a trade too. If you're being honest and you're journaling correctly, these are the times where you're writing down in the journal, I had to really work hard to get through that period of time between 8:30 and 9:30, waiting for the market to move in my favor. And I had to wait 30 minutes to do it. It was uncomfortable, but I'm glad I did it. You're recognizing that it was hard to do, but you're also rewarding yourself in your journal that you stuck to it. And while it was uncomfortable, it was not enough to change your mind. It wasn't enough to make you so scared to close the trade. You stuck with the process. And there's going to be times when you do this over months and years that you won't feel that, I guess, nervousness or uncertainty. You just know that this is what you have to go through. It's normal for you to feel that. Okay. So what we would look for if you're down in the lower time frames, that low and that low, you see that? The market drops below it here. We don't need it to trade below that yet. It's already done that here. Everything is geared for it to break lower. Every time after that stop run right there, every high was lower. Lower than that one. Lower than that one. Lower than that one. Lower than that one. You see that? So all it's doing is giving a signal to smart money that everything's the way it's supposed to be, and every single time we're inside this range in here, they're adding more to their shorts. And retail is hoping that that was support, and they're trying to buy it. And they're looking at ICT videos on a binge watching or a 5-minute crash course on ICT. Learn ICT in 5 minutes. Oh, this is that gap. So when it trades down here, let's go long. You didn't hear me talk about going long today. You didn't hear me talk about that at all. Oh, well, here it is. It's going down and trading into that gap again. And now that's the one that's going to go up. No. But watch what it does. It does break below these lows here on that candlestick. And then the market trades back up into a bearish order block. This candle and that candle together, that is an area where inside that range, if the market can touch that area once more, treat it like the same way as trading into a fair value gap, like what I showed you on the 5-minute chart up here, that you're entering in there. This range right here, that's them getting in the last bit of opportunity in terms of timing where they can go short. I'm going to change that color. Give me a second here. And I'll change this because it needs to be different because it's bothering me. All right. So these up close candles, I don't really need that second one because now I can see that this one is shorter than that one. So this is the order block because this is inside the range of the previous up close candle. What is an order block? What is it? Because if you're listening to anybody else, they have no idea what the fucking order block is. Okay, it has nothing to do with timing sales. It doesn't have anything to do with a ladder or depth of market or DOM. It's DOM, not dome. It's the change in the state of liquidity. Okay, it's where you are in the marketplace and how it changes its delivery, where it pinpoints a very specific time. It's specific in elements that provide you a very unambiguous range in price, where if it can trade to it, think of it the same way you do with what I taught today with the fair value gap. If you're bullish and market trades higher and trades back down into the fair value gap, you want to try to key up an entry with all things being equal and it's still bullish. The equilibrium price point, or if it's a fair value gap, it's the consequent encroachment, the halfway point. Or if it's a candlestick that makes an order block, the midpoint is mean threshold. It's expected to at least try to trade into it halfway. Those halfway points are important because if it can go to just half of it or fall short of half of it when you're bearish, or go down to half of it or trade just above halfway and then go higher, it indicates a signature in terms of strength of the move. It gives you that little bit of detail to say, okay, yeah, I'm not only am I on the right side of the marketplace, and it's probably going to start moving in my favor, but it's really going to move in my favor because it couldn't even trade to the midpoint. You see what I'm saying? It's a diametrically opposed contrast to what I was saying about stop hunts. You want to see a stop hunt where it goes against your direction, because then it really gives you the indication that it's going to move a lot, because now somebody has been unseated, and the only people that do that is the smart money. The smart money that will capitalize on someone else's missed opportunity, and then they ride the longer run higher or lower. Well, it's different when it comes to order blocks. You want to be able to see it not trade to the midpoint or mean threshold, but you allow for it. But your stop loss has to be outside the parameters of the order block. In this case, we have this up close candle here. Okay, if we can trade up into it, like in here, where it does that, this range here, I'm going to throw a fib. I'm going to take this range off the box so that way you can see what I'm measuring here. This to here, that's midpoint. Okay, or what? Mean threshold. Mean threshold measures at 17,678.75. Okay, so it's 8.75. What's the high of that candle right there? You're going to look at it right up here. Okay, what's the high of that candle? Holy shit! What's the chances of that? Right to the tick. 30 years, you're never going to not love it. It's still a beautiful thing to see. It's perfect. You can't get any better than that. Can you improve on that? Can anybody improve on that? Nobody can. But ask the Tom, Dick, and Harry's on YouTube teaching order blocks to show you that. Because they am. But this order block here, there's a certain caveat that needs to be applied to this. Okay? What is that? When I spoke earlier in the lecture, I taught volume imbalances. And what is a volume imbalance? A volume imbalance is any time frame where you have two candles immediately right next to each other. It's like this. Now these form with bullish price runs when it's buy side delivery, or bearish runs when it's sell side delivery. That means movement higher or lower. Taking the wicks out of the equation, because that's not what we're referring to when we're talking about volume imbalances. A volume imbalance is the difference between the candle that you're looking at and the one prior to it. Okay, so it's only a two candlestick or two time interval. That's a more specific way of defining it. Two subsequent immediate candles or time intervals that have a measurement of the open or closing price that do not touch. See that? Now, if there's no wick, being shown in the delivery of the candlestick, or when the candlesticks paint on your chart, they, by theory, you can have a candlestick like this, where there's the highest high and the lowest low is the open and the close. It's rare, but it happens. But what we're looking for is the difference between the bodies. Okay. So if there's ever a separation between the two, like this, and the wicks can have this, like it could do, and it's not going to line up because it ain't going to line up. It's not going to be in the center of that, and I'm not going to monkey around with it. So the wick could come all the way down into this area here. So it could eventually be viewed as it's overlapping, and the wick on this candle could go all the way up to here. But my eye and I'm training you as a student to look at that separation between the bodies, because the majority of the volume of trading is done inside the body of the time frame that you're measuring. Okay, not numerically in terms of, okay, if you pull up a volume profile, I'm going to look and see there was more contracts traded here versus here. So he's full of shit. I'm talking about the volume of smart money's trading. See, they're not going in where you think they're going in at. They're going in where I'm teaching you where they're going in at. I'm teaching you that. You don't know that. I'm behind a barrier where I can only go so far to explain certain things, and I can't go past that. And that pisses a lot of you off. And because I don't do that and I won't do that, I'm labeled a scammer. But how many times are you watching me doing this stuff? On Twitter, we did it all the time. Every 1 minute candle being called out, explained what was going to happen. But this is a volume imbalance. So what you do is you have to incorporate this little range in price action. That has to be factored in your analysis. Now that might act as one more instance where you can trade up into it, and then I can add another partial for a pyramided larger position. Or it could be it's going to trade up to that and that's my exit. Or it could be I have to use this as that's my third PD array and I'm bearish. So now I have to put a stop loss above this. So where would the stop loss need to be? It needs to be above the candlestick's high that forms this volume imbalance, which would be this candlestick right there. This candlestick need not be a swing high. It could be another high over here. And it wouldn't look like you would pick that candle. But it's the same framework I use for what? A fair value gap. So it shares similarities and characteristics for managing and employing it for entry, partials, and now I'm introducing how to use it for stop management. So if you're using this as an order block, there's nothing wrong with that, but you just can't just say, well, that's my one trick pony and that answers everything for me. No. Your entry needs to be inside that candle's range, yes, but you also have to define the risk because now you have a volume imbalance that's inside this candle here, right before this 2 consecutive candles, but we've learned that this is not important because this one's the entirety of the range. And let me say it slower and simpler. This up close candle is not relevant in terms of defining a order block. This candle's high is above this candle's high. So we don't need to even refer to this. So that's why I measured that range with the box, showing you that up close candle is the order block. It does trade up into the volume imbalance, but that volume imbalance can do what? Remember what I taught on the lectures on Twitter? And remember what I taught on live sessions and lectures on the YouTube channel? Volume imbalances, you have to be what? Flexible. They can pass through them and be used multiple times. So because that is there, you have to define the risk with, okay, what's the candle that creates that volume imbalance? The high end of it. It's this candle. So your stop would have to be where? If you're going to use that as your entry, your stop has to be above this candle's high by 1 tick. So that would be 89, or I'm sorry, 88.50. Let me see what the high is. Yeah, 88.25 is the high, so 88.50. That's your stop loss. And your fill would be ideally using the opening price, which is 77.25. So about 10 handles. That's really small for NASDAQ. Like that's really small. So that's why I taught in month 4. My old age is kicking in. I'm going to be 52 this year. And I think it was month 4 in the mentorship. You can find it on the playlist in the YouTube channel, where I teach the PD array matrix. And I show you where all the PD arrays exist and how they nest together and what order they form. You do not see me introduce the volume imbalance in there. Why? Because the volume imbalance can appear and form anywhere in the spectrum of your dealing range. But they all are influential. So if you have a volume imbalance inside of your dealing range, in the time frame and time frame that you're trading off of, you have to extend them to the right because they will absolutely have an influence on price. And how do you use that? With managing a stop, you have to factor in the fact that, yeah, price should only go into that volume imbalance, but the rules for using it is you have to allow for static price action. Remember, it can color outside the lines, especially during high impact news driver days like today was. So your stop loss has to be here. Okay. So I have literally given you a clinic today. I told you what was going to happen before it happened. I told you why it was going to happen. Told you the timing of it. explained where the exact high of the session was going to be with that fair value gap on the 5-minute chart. Did it color outside the lines? Yes. Does that indicate or promote the idea that the concepts are flawed or don't work? Absolutely not. It was exactly what I outlined today. Exactly. And all you little piss ants that make these YouTube videos about me are stuck dealing with it. So let's go a little bit more in depth about order blocks, and then I gotta get something because I'm fasted and I'm hungry and I need to eat. So let's get this business off. You're getting some extra credit here. I'm 20 minutes past my set. I was gonna stay and leave at 10. No extra charge. All right, it's a 5-minute chart. Let's go into that. Alrighty then. Excuse me. All right, so now we have that fair value gap right here. Okay. I want to say this, and then we're going to finish with this business here on our order blocks. But we have the fair value gap I pointed to live. Before it traded up into it, then I said, it's done. It doesn't need to do anything more. It's done. It's done enough for me. Now, if you're using that as your entry strategy, or if that's your model, okay, it overlaps with multiple things here. It overlaps with these consecutive up close candles prior to this rotation lower, and that shift in market structure below that low there. So you got to go back inside all this price action here. Where's your up close candle? You can't use just this one because you're not getting the full picture. Because if you're demanding it trades all the way back up to the low of that candle, you're going to miss trades. You're going to miss them. Okay. So how can you manage risk appropriately? How can you still engage the market using an order block correctly? And as its author, me, I can tell you right now, this is what you do. Okay. The up close candles that are in succession here, one after the other, that entire range has to be defined. That's one entire range. Now, you don't know, and I'm not going to be able to teach this part of it to you. So I give you the easiest low-hanging fruit objective on how to incorporate them in your trading. You may come away with this discussion today. So you know what? I've been waiting for more discussions about order blocks, and I'm not sold on the idea. I'm just going to stick with fair value gap, or I'm just going to stick with model 2022, or I'm going to stick with the silver bullet. That means that you're mature. That means that you have grown in your understanding and you practice what I preached in this lesson earlier. Don't let me influence you to do something outside of what you've grown comfortable doing and change something that already works for you, or undermine your development up to a certain point. Or if you're in a trade or if you're about to take a trade, don't let my expectations about the marketplace, because you don't know what I'm trying to trade for. You don't know what I'm aiming for. You don't know if that's just one entry point to a larger position size I'm going to build as it keeps moving in a particular manner. So because I'm not going to teach you or tell you what I'm doing with my trades, that's always going to be a factor. So don't let me ever influence your trades, ever. If you've done the homework, you've done the math on it, you're willing to take that risk, let the outcome be based on your management, your adherence to it, and your credit is deserved at the end of it, whether it be good or bad. And you can't say it's my fault that you made the money, and you certainly can't blame me when you don't make money. So this range here, we have the high and the low. Okay, that is your range for a bearish ICT order block. Okay, in that range, you grade it. So we have the up close. We're not measuring this low here. Why aren't you using that low ICT? Because it's not an up close candle, and it's the time frame we're using here is the 5-minute. Why am I using the 5-minute chart? Because it's a high impact news driver day, and you're not allowed to trade with anything less than a 5-minute chart on a news impact event that's high impact. So in your economic calendar, you can use forexfactory.coms, you can use Econoday calendar, you can use anything else out there, okay? But it has to be something that's accurate. So those are the two I've used forever, and they'll serve you well. So this up close candle, that is the the low end of your bearish order block, and then the high end is where the last up close candle, its high is, okay? And now we put the lower quadrant, the midpoint, which is mean threshold, and the upper quadrant in the high. In an ideal world, just like the same logic when I'm using my fair value gaps, okay? If I'm trading inside of a buy side imbalance or sell side inefficiency, the scope is the same, okay? Ideally, I want to see a sell form between the low and mean threshold. That's the ideal, if you want to call it optimal area of entry inside a range that is an order block. If you are listening to Tom, Dick, and Harry's mentorship on YouTube or anywhere else, and they say the last up close candle is your order block, it's not always that. That's why I've been telling you all, you guys don't know what you're talking about. You don't know what you're talking about. You're learning today, and you'll be seeing all kinds of shit all over the internet now. But I told you I was going to come here teaching today. So this is where you want to be looking for your shorts. Can it trade all the way up here? Yep. What happens if you enter in here and it stops you out? You just took a trade prematurely, and you wait and see, does it give you more indication that it wants to go lower, but it needs to leave the premium side that makes this range. So if it goes up there, you're going to have to wait for it to make a low, break the low, and then the next inefficiency after that, because then you'll have what? A market structure shift inside the range that acts much like what? A dealing range. So your order block is what? It's a dealing range. But it's very specific with this part. What I'm about to show you right now, this is what makes an order block an order block, okay? You're going to learn what this is today, and then anytime you see people putting shit up on Instagram or their mentorships, or you have the multi-level marketing boys trying to teach you what they think is an order block, they have no idea what they're talking about. We're going to take this range here from the low to the high, halfway point, that little area here, that's a sweet spot. That's your point of where the best of the best entries are going to form. So in this range here, what do we have? Well, we have a breaker. That's in the lower area too, lower half of the order block range. We have the fair value gap here, the one I pinpointed to you before it happened. And we also have the optimal trade entry. How many things are there saying that this is going to go lower? Multiple, right? Any one of them could be your unique trading model. Is any one of them better than the other? No. No, none of them. None of them have any distinct advantage over the other. So, as I mentioned when I was teaching my paid students, when they come to the realization that all of my setups, that when I'm taking a trade, I don't just have one thing saying I'm taking that trade. See, some of you don't realize I'm answering the question that a lot of you have been asking me. Why did you pick that and not this? Because I have a confluence of the things that I use and can employ as a trader to get into a trade. I don't just have one of my tools saying this is a trade. I have multiple things saying this is a trade. See, when I first started, I was that insecure 20-year-old that had to prove himself. And I had to constantly give myself the assurance that I would have setups that can be trusted, because I hurt myself so many times trusting books and people I read about on the internet and tried to do certain things, and I tried to use indicators, and those things hurt me. I put faith in things that were not really valuable. And I would beat myself up thinking that it was me that was doing it wrong when it was the underlying horseshit that I was trying to adhere to, when none of it works. There's such a thing as technical science, and you're seeing it today. We're talking about very specific elements that repeat every single day. Every single day they repeat. But you may not have the gearing mentally to try to trade the market in that direction. So that's why I tell you in the beginning, don't hold a bias, because you're going to be wrong most of the time in the beginning. What you want to see and study is every time there's a volume imbalance that forms. When a volume imbalance forms, mark it, note it. Remember the one I showed you here? Go back and listen to that time around 9:20 or so in the live stream. That small little volume imbalance formed, and I told you when it was trading up, my eye is right there. I want to see how it behaves there. What did it do? It's overshot it by a little bit, and then boom. See that? That's experience. That's things that my eye jumps to. They're called signatures. Okay, that's a smart money concept that's being expected to behave a specific time in a manner in which the bias is deriving the outcome. It's directing the outcome, rather. So the things that you have to hold on to hardest and like wrap your arms around it, close your eyes, say, come hell or high water, until I'm proven wrong, I'm sticking with this. That's bias. That's what you frame with the market when it's not trading on the weekend. You either do that after Friday's close or before Sunday's opening. You have to come to your bias before then. If you can't come to a bias that you trust, don't trade on Mondays. Let Mondays frame the little nudge that you might need to get into a better favored outcome for bias. That way you can have a little bit more information. Be willing to let the Monday trade without you. Okay? So if you were utilizing this fair value gap here as the entry, as I was outlining today, that was the one I was focusing your attention on during the live stream. Where would your stop have to be? Not this. You can't be this high. Some of you are like, oh, he's going to point. No. Go back and listen to the rules of the fair value gap. This is the candlestick that creates the high of the fair value gap. In other words, this candlestick's low is the high of the fair value gap. This candlestick's high is the high. I'm sorry. I think I said that wrong. This candlestick, let me widen it up. That candlestick's low is the high. It's the high watermark of that shaded area, which makes my fair value gap. This candlestick's high is the low of the fair value gap. So the candlestick that makes the barrier high in a bearish fair value gap, that candlestick's high plus one tick is your stop loss. Well, that's a lot of pips. I can't, or that's a lot of points. Well, whatever. Then don't take the trade. Or trade with smaller leverage. How's that for logic? But your protocol, when you're starting out like it was with mine, how much can I make? How much can I make? And how much do I have to trade to make that? And how much margin do I have to trade with? Versus how can I manage the risk, the mental anguish that it's going to put me through, because I don't have much experience when I'm first starting. So therefore I have to do what? Trade with the smallest of leverage. And don't look at that as a weakness. That is a strength. That's a strength. It's like when people join young men. I did the same thing when I was younger. When I joined World Gym and I wanted to be like Lee Labrada. You know, I want to have a physique like him. And I was like, well, I'm gonna do the maximum weight. And I'm going to work out for 4 hours. And then I was sore for a week and I couldn't go back in the gym. But I thought that that's what had to be done. Big weights, long trading sessions. No. When I did measured routines and I started eating more protein and doing all those other things, listening to lectures that are not getting to the point. See, y'all have TikTok mentality. You want shit given to you like that, and it's already 2 days late. And you wonder why you ain't making any money. You wonder why you can't do it. See, I'm a dinosaur. I'm a Gen Xer. We're the last generation the real generation, because we did shit that y'all would melt in. We went through stuff. In trading, it's gonna be hard, and you have to have rules, and you have to only operate inside of these rules, these boundaries. And any results outside those boundaries should not be measured, because they are a direct reflection on you not fucking listening. You're doing things wrong. You're crossing the yellow line, driving too fast. And what's the recipe for that? Accidents, damage, death. And you think something's going to be different in your trading? Somehow it's going to be different? No, it's not going to be any different. It's going to be fast and furious, and you're going to blow your account. And how fast can you go out and buy a new funded account? How fast can you refund an account if it's real funds? they should be weighing heavily on your initial actions as a developing student. So I've given you a lot here today. I taught you how to use the fair value gap and order blocks for managing risk, managing the entries. Where's the best entry strategy for using an order block? When do you use the last up close candle before the down move in price? If you're looking for a bearish order block, because some of you are probably thinking, I wish he would have said, I heard you. How the hell do you do that? I mean, your head. He's reading my mind. This is weird. All right, so we have a price run, okay, that may have a series of green candles or up close candles, because my up close candles are green. You'll have a series of up close and then maybe one or two down close candles, and then you'll have a down close candle right before your last up close candle. Okay, if there's a break in this, for instance, let's say this candlestick right here was a down close candle, or it would be a black candle for my charting, then I would have used that candle as my bearish order block, and none of this down here would have been a factor for it. How's that for simplicity? Real simple, isn't it? But if you ever have a series of immediate consecutive candles, you have to define the range that all of those candles make. Divide it in half, divide it in quarters, and the best setups are going to form below mean threshold, which is the middle of the entirety of the multiple candlesticks that make up my ICT bearish order block. So also the importance of, if you're buying down close candles and you're treating them as a bullish order block, you absolutely do not buy a down close candle that's outside of the range that just broke. Okay? Never do that. Okay? Because you don't have the experience to know if that range being broken to the upside is going to be sustained. You don't want to do that. So what you want to focus on is this. I need the trend line thing here. After I say this, I'm done. Okay? I gave you extra, so you shouldn't be mad. Come on. All right, in terms of price, generically speaking, if you think this is the part that's important, okay? If you think that the market is likely to get up to, say, here, okay? Stop worrying about price right now. But ICT, you got your own charts. I'm teaching you something. If you believe that the market's going to go up here, and we traded, and now we created a dealing range, and I've already defined how to determine a dealing range, but your bias says it's going to go up here, okay? In this run here, that's your dealing range. Splitting that in half, like that, where is the ideal entry points for a order block? Is it down here or up here? If you're watching this and pre-recorded and you're not live, pause the video and think about it before you answer it. Everybody here live, I'm forcing you to wait. All right, let's see here. That's about enough time. You want to see a down close candle in the upper portion of this range right here. So it would be like this. In that area, good grief, that's your area where you would look for a down close candle in here. Okay? Caveat. Now this is an amplification of the lesson of me teaching the PD array matrix, my students that paid me did not get this lesson. So you're getting something fresh right out of the oven. If there is a fair value gap on the time frame you're looking at, in this range, or the lower half, you do not buy a down close candle in the upper portion because it won't hold. It will drop down and reprice to the inefficiency that many times will have a order block associated with the fair value gap. Those two together will be confluence, and you're in a discount here. And then you can reasonably expect to see the market do that. Okay, so that's why it's important that you start with one PD array, learn it, but it's not going to stop there. You're going to need to know the PD array matrix, even if you don't use them as entries. Understanding what they are and how they form inside of a price run, it's part of the whole process of determining, why do I buy that down close candle and not that one? Why do you buy that fair value gap and not this thing? How are you able to pick this PD array and you ignored this over here? I just taught you today. See, there's certain things that are germane. They're salient points that are useful because they're my concepts. I know what I'm doing with them. You don't know what you're doing with them. You only have an introduction to them. But an introduction still is light years beyond the scope that retail stuff works. Far less than this will. This stuff it's finite. There's rules to it. What's support and resistance are you going to trade? Which support and resistance are you going to trade? How do you define your support if it's retail derivative? What defines that for you? Everybody's going to have a different diagonal trend line. Everybody's going to have a different support or resistance level, unless we take our attention to everybody uses one time frame. It's the XYZ time frame. It's the 15-minute chart. It's the hourly chart. If all of us were forced to say, okay, by a show of hands or multiple choice or whatever, is this the support you would you use as your support for that time frame? And say we're looking at hypothetically a 15-minute time frame. If that's the case, and we're all forced to give our personal opinion about what is support and what is resistance, we'll probably have a closer clustering around one or two levels that would be predominantly viewed as support or resistance. But how many of you are trading off of a 15-minute chart? Not most of you. Most of you are looking at 1-minute charts because I've poisoned your mind thinking that the 1-minute chart is the answer to everything, and it's not. It's an answer to reduce risk and give you more entries, but more entries are not a requirement to do well. You want one good one, and that's what this over here teaches you. And it probably went right over your head. You're probably thinking, man, this is, what is he talking about? Right, but the people have been doing this for a while. They just had an epiphany right there. They're understanding now why their down closed candles they thought was a bullish order block went right through it and went lower, but still respected the dealing range. Didn't go lower than here. How do you know when to buy it down here and when to buy it up here? He's buying in a premium. Why is he buying in a premium? His video says, I just told you why and when. Oh, it's fun being ICT. So anyway, only for this year, because ICT is not ICT no more at the end of this year. ICT is just Michael, just hubby, just daddy, and just boring old me. I can't wait. But that's the business for today. I hope you all learned something from it. I had a lot of fun today. I enjoyed hanging out with y'all. And let's take a quick look at ES real quick. And you know what? This shows you I'm a noob with TradingView. Now, if this was TradeStation, I would know exactly what I'm doing here. But I just removed the price charts. There you go. That shows up, but now I can't get the bars to come back. Look at this old guy. I guess we're not seeing that, are we? Let's do this. ES. It's time frames, 30 seconds. Let's pull up a 15-minute time frame. Maximize it. All right, so we've taken out the February 21st low. I want you to take your attention here. See how clean that is up there? I'm not saying it's going to go up there today. It can. I'm not trading it. I'm going to have lunch when I'm done, and then I'm going to relax the rest of the day because I've talked myself almost hoarse. I'm going to probably have no voice tomorrow. Some of you be like, I'm glad. But the point is this. We've moved low on this for a series of days. If this is going to be a long-term continuation to the uptrend, okay, I would want it to stop today and then go higher. If it can't do that, and if it can't stay above the low that's formed today, then we're going to go lower. If it keeps the low intact today and tomorrow we don't break today's low, this is the draw on liquidity for me, you know, in terms of looking at where it could go, but I'm not trading it. Now, why would I go out and say that? Because there are times where, like I was explaining to students that I worked with on Monday live, when I'm managing expectations or I don't know very specific elements of what I want to do on that session or that trading day, I put parameters on price and say, okay, I would like to see it do this or that. If it does this, or if it does that, or it fails to do this, then it'll give me clarity about what I want to see happen in price. There are times when I'm sitting down in front of charts and I'm like, I don't know what it wants to do because there's a plethora of things that could pan out from where it's at right now. So what does that mean? It's not high probability. So if it's not high probability, I have no business trying to co-sign an expectation or forcing a view on price action that probably isn't going to pan out. So I want to wait for times where everything's really loaded in my favor. I have many things suggesting it's going to behave a certain way, and that's pretty much what you should do. You know, if there's ever time where I'm telling you what to do specifically, it's that. Demand more things that are in your repertoire to suggest the market's going to behave a specific way. And if you have just one thing saying that's probably not going to happen, then you probably shouldn't engage it with real money or a funded account or even a demo, because you're feeding something that has the low threshold of panning out. And that's basically like trading just to see what happens. You know, the demo mindset. Let me see if I buy this. What would happen if I did that? And you went into it with you don't really care. You're interested to see what happens. You might have an expectation of it working out. But when it does pan out, you elevate that moment to I know exactly what I'm doing. I'm a rock star. Or if it loses, you're like, well, I wouldn't have took that trade anyway. You see how that's toxic? But you spend months and weeks doing that initially. And then you think, well, I'm tired of messing around with this. Let me put more money in there, or I'm going to try to do a funded account. And then I'll see if I can make it work that way. Like, that's going to change things. The only thing you're going to do is discover that you have poisoned your mindset doing all the wrong things in the beginning, which is why I teach ad nauseum and tell you things that you need to know and how you should think. And you don't want to hear it because you know better. Well, if you know better, then you wouldn't listen to me or anyone else, would you? But here you are listening to me. So anyway, I just want to compare and contrast real quick. Dow. See how it's already went up above its relative highs? In NASDAQ. Same thing up here. Okay, so if we create the low, and again, to frame why I would say that, why should I even imply that if it's going to go higher, I would demand that it creates the turning point today and today's low be intact. Because if you look at the low here on NASDAQ, and then we made a lower low there. You see that? If you look at it on ES, see the divergence there?
So that's S&T divergence. And then finally, one more time, the Dow, really big divergence. And because it was unwilling to make the lower low or even get close to how the ES failed to make a lower low, this is the relative strength leader to the upside. And that's why it already traded closer to its relative highs than that of ES and or NASDAQ. Okay. So anyway, that's the business, folks. I had fun. I'm hungry. I want to go get something to eat. And hope you had some fun today. Hope you learned something. If you didn't take notes, this is one that you want to go back through again and just listen and maybe take screenshots of what I was showing you. And I'm confident it'll serve you well. If you can't frame the market like I was showing you here today, chances are you probably shouldn't be trading that day. If it's not this clear, if it's not so cut and dry, black and white, it's just right down to the chrome, this is what it should do, then you're probably in a market environment that you shouldn't trade. And you're not going to be surprised when you lose money. Or you shouldn't be surprised then, because this market was absolutely set up to do everything and all the things that I outlined today. There was nothing spoke to you that was ambiguous. There was no flip-flopping. I didn't have both sides of the marketplace. I took your attention right to the very core essential moves, where it should turn, and there was nothing extra to it, okay, except for all the things that were supportive in terms of your trade psychology, your development, how to practice, and how you should think about things. And a reminder that an asshole down in Texas can't trade and he ain't in the Robins Cup. So until I talk to you